Americans withdrew close to $100 billion the week of March 15th as Silicon Valley Bank and Signature Bank both failed. Personal finance editor for AARP, George Manis, is with me right now. George, first it was those few ripples in the banking industry. Then it caused a lot of uncertainty, people taking their money out, which makes the banking industry very nervous. So how shaky are we?
I think we're actually in very good shape. The Federal Reserve issued a report after the three big banks fell earlier this year, and they said overall the banking sector looks strong and resilient. They blame those particular failures on just poor risk management at those banks, and they said that they are increasing their oversight of the banks that they deem vulnerable, checking them more often and checking them in more detail.
How does this affect anybody who's watching's retirement or 401k? Are those accounts affected in any way by just some of the whole lot of rolling and shaking we've got going on with just people's nerves in the banking sector?
Well, that's the thing about investments. Good news comes in, bad news comes in, stocks go up, stocks go down. The important thing to remember for most people when they see something about a bank failure and they think about the Great Depression and they think about Jimmy Stewart in It's a Wonderful Life, most people just do not have to worry about their savings, the safety of their savings at a bank, even if it does fail, because there is a lot of insurance in place at both banks and credit unions that should calm them down.
What's the difference for those who might have thought, OK, I'm taking my money out and I'm putting it in a credit union because that's going to be different, that's going to be safer? Is there a safer alternative, or can you just kind of just give us the brass tacks of how they are different?
They're really different in name only. The protections you get are equivalent. In both cases, both a credit union and a bank, each deposit, everybody is insured for $250,000 per institution per type of account. So, for example, let's say I'm lucky enough to have $250,000 in savings and checking at a bank, that's insured. And let's say I'm really lucky and my spouse and I have a joint checking account of $500,000 in addition to my individual account. All of that money is insured. The joint account is insured for $250,000 per person, and the account in my name only is insured for $250,000.
And the cool thing is that savings account rates, because of inflation, are going up. So make sure you check and see what the competitive interest rates are for different banks, because they're offering some good deals right now. George Manis from AARP. Thank you for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.